investors, very rarely do I like to actually sell stocks. It kind of goes against my buy, stash, and collect cash mantra that I try to promote on this channel. But sometimes I do have a change of heart, and today I'm going to be sharing with you why I'm going to be selling all of my utility stocks. Utility stocks tend to be big dividend payers, and that means I'm going to be giving up some big dividend payments. Currently, I only own 2 straight up utility companies, though we can make the case that other companies such as AT&T could in a way be a utility. The 2 stocks that I own are SO, Southern Company, and Duke Energy, ticker symbol DUK. Now the reason I'm selling is not because these are bad companies, but it's just that I think the capital associated with them could be used in better ways for a younger investor like myself. Let's take a look at why investors love utility companies to begin with. First of all, they are often very recession-proof because they offer everyday items we all need, such as gas, electricity, or water. Even when the market is going down, people will prioritize making sure that they have their light bill paid. This turns into very reliable and consistent income and cash flows. Utility companies often have low betas, which means there isn't much volatility when it comes to these particular stocks, so investors don't have to worry about huge price fluctuations or eagerly be tuning into quarterly earnings reports. Utilities are often legal monopolies. Some local governments will not allow other competitors into a company's turf, no matter how slow they are. Xfinity, we're looking at you. And probably best of all, they often pay out most of their earnings in the form of dividends to reward their shareholders. While that might sound good, almost everything I said as a positive could also be a negative for a younger investor. Sometimes when you limit the floor on how low a stock can go, you also limit the ceiling on how high a stock can go. Because they are often regulated monopolies, they often have limits on how much they can charge customers, they have to get permission to raise prices, and they have limited prospects for growth potential. All that means that there's almost a hidden parachute causing a drag on maximum returns being achieved. Utility stocks also just don't really fit anywhere in my portfolio anymore. Now that I have income ETFs, these pay me monthly dividends and give me a high dividend yield. Their dividend yield is often 2x the dividend yield of my particular utility companies. They also obviously don't fit into the growth side of my portfolio since they're most likely not going to be beating the market over the next couple decades. But that's not to say that they can't be profitable or that they haven't made me money in the last couple of years of owning them. I currently own 14 shares of Duke Energy for a current value of $1,376.76, and my cost basis is $1,117.23, for a total return of $259 or 23%, and that's not including the around 4% dividend yield I've gotten every year just for holding them. I also own 11 shares of Southern Company for a current value of $689. My cost basis on Southern is $574.99, which means I have a total gain of $114.05, or nearly 20%. And of course, that doesn't include around a 4% return I've gotten every year in dividends just for holding them long term. I certainly made more just owning these 2 companies than I would have maybe just holding bonds, but I also bought these companies at great times. I started swooping in for more shares of Duke right during the C19 crash, right when it started, when the share price was down pretty heavy. I bought in at some great times, but that type of timing is not typical, so my returns are probably a little bit more inflated. So my total returns on utility companies are probably a little atypical than the normal return you can expect in 1 year of just holding them. Altogether in dividends, I'm going to be giving up $2.64 a share for Southern, or $29.04 for the full year, and $3.94 a share for Duke, or $55.16 for the total year, for a grand total of $84.20. Now that's not a small amount by any means, but I feel like I can get better returns if I use this money toward doing options trading. I want to eventually reach 100 shares of the triple Qs and 100 shares of SPY. SPY of course does own utilities in its index, so I'm still going to be getting a small amount of exposure there. I figure I can make more money doing options trading than I can owning these 2 in the long run. I really do feel like the risk outweighs the reward. And again, I just want to emphasize, in no way am I saying that Duke or SO are bad companies. I may eventually even buy back into them at a later point. They just don't fit into my status quo right now. I've also held all my shares for over 1 year, so regardless if I sell today or if I sell 20 years from now, the tax rate is always going to be at my most efficient long-term capital gains rate. And it's not like I'm selling these shares and using that money toward buying, I don't know, candy. I'm going to be reallocating all the money toward other dividend paying stocks or ETFs. Now, I know this might be a very unpopular decision, but please let me know in the comments what you think about my choice. As you're liking the video, commenting, and subscribing, I know I will disappoint some, but I really do want to hear it. Remember, my videos are always available in the audio form on the Collect Cash podcast. And even though I'm breaking the tradition today, don't forget to buy, stash, and collect cash.